Will I be doing what? Sorry. Oh, are we starting now? Are we live? Good morning. Welcome to the update of the International Monetary Fund's Global Financial Stability Report. We're obviously coming together at a very interesting time when the economy around the world looks like it's poised for a pretty good rebound, but we're still stuck in this very weak spot because of the pandemic. And yet financial markets seem to have anticipated great news ahead. They're very buoyant in very many places. This is a great time to check in with the authors of the Financial Stability Report. I'm pleased to be joined this morning by Tobias Adrian. He's the Director of the Monetary and Capital Markets Department at the IMF, and Fabio Natalucci, who is his deputy, who is the principal author of this report. Good morning to both of you.
Good morning.
Hi, Greg.
Hey. Tobias, let me start with you. So we've all seen what's been going on in the financial markets the last few weeks. Equity markets around the world have moved up very sharply, but especially in the tech sphere. And we have seen enormous froth and speculation in many corners of the financial markets. How worried should we be about this? You talk in your blog report and in the update about the the chasm between financial market exuberance and the reality on the ground. How worrisome is that?
Yeah, that's a very good question. Of course, what has triggered the most recent rally in equity markets is the good news about the vaccines that started to come out in November, where we learned that vaccines are efficient, that they can be rolled out across countries in the world. And of course, the absolute end to this pandemic is going to be a medical solution. So the vaccine news was a very good one, and it has driven up valuations. Furthermore, throughout the year, of course, the monetary policy support by the major central banks, but also by emerging market central banks, have supported asset prices by easing financial conditions. Now we are in a place where the easiness of financial conditions is helping economic activity, is helping countries and corporations to issue debt, but it's also accompanied by a run-up in asset prices, particularly in some sectors. And we do worry that there are stretched valuations in some sectors. For example, in the tech sector, we're detecting some frothiness, as you point out, and there's certainly a risk of a market correction here.
And how much of a problem would such a market correction be? I mean, you can imagine a scenario where the principal effect would be that some people who took too many chances with their walking around money get burned. But you could think of scenarios where that has more systemic consequences. Walk us through the possible chain of events that could follow such a correction.
Yes, absolutely. So the good thing in this crisis is that the banks went into this pandemic in a very strong fashion. We have spent the last decade reforming the regulations of the banks. They went into the crisis with a lot of capital, a lot of liquidity. And even though we saw a very, very sharp economic contraction, the support on the monetary side and the fiscal side has contained the bankruptcy so far. So the banks are in good shape. So that is extremely important from a financial stability point of view. On the market side, of course, there's the worry that we could see further sell-offs. And last year in March, there was a very, very sharp sell-off that led to central banks stepping in and really backstopping a very broad segment of financial markets. And we could certainly see further sell-offs at some point, at least in some segments of the market. As you allude to, this might not directly impact financial stability in an adverse way, but it could lead to a tightening of financial conditions and could thus be a headwind to macro activity and to the recovery.
Okay, a reporter from MarketWatch asks the following: anything to say about Reddit-fueled stock trading? As for those listening in, what we're talking about is that there's a handful, actually more than a handful, small stocks which have had huge surges in value in the last few weeks. And it seems to be a lot of that driven by chatter and rumors on message boards and on social media, such as Reddit. Tobias, I'm not asking for stock picking advice here, but as a general matter, should this be something policymakers are worried about, what appears to be extraordinary froth and driven by these sort of opaque chatter channels?
Yeah, so there's certainly been a move into day trading by some of the population that is working from home or that is perhaps out of work. So we have seen a surge in day trading, and this is somewhat resonating with '99 when there was this move towards day trading. And in certain segments of the market, in particular in some of the technology stocks that you alluded to, we do see very strong surges. And so there's a tug war going on in between some who view these particular names as overvalued and others who are speculating on further rises. And we would certainly expect quite a bit of volatility that is possible. Of course, when this might occur is uncertain. But at the moment, these are pockets, and the overall valuations are not fully driven by that at the moment.
Thanks. The following question is, I'm going to direct it to both of you, and you can both answer because this relates to all markets, and it has to do with reach for yield. This is a phenomenon that when central banks are providing extraordinary levels of liquidity via quantitative easing and zero interest rates, that there's a rush or reach by investors for much riskier instruments simply because safe instruments yield so little. What do you see in that phenomenon in terms of both credit markets and emerging markets? I'd like you both to take a piece of that question and give me your observations.
Yeah, why don't I start with the credit markets and then pass to Fabio for the emerging markets? Easy monetary policy and asset purchases in particular aim at easing financial conditions. So, lower interest rates far into the future and lower credit spreads are the transmission mechanism of unconventional monetary policy. And of course, the goal is to allow borrowers to borrow in order to finance economic activity and to get the economy restarted. And we have seen that type of policy being very successful in 2020, and it's certainly expected to continue for major central banks as well as emerging market central banks throughout 2021 and further into the future. So what we see are low interest rates and very tight credit spreads, which has helped to fuel a boom in issuance of corporate bonds as well as sovereign bonds. That is very good in terms of supporting funding, investments, and economic activity more general. But of course, as a policymaker, you always have to watch that there aren't excessive risks that are being taken in different segments of the markets. And so we are watching, along with regulators around the world, we are watching very closely whether underwriting standards are deteriorating and whether there are any unintended consequences. So you want risk-taking, but you don't want excessive risk-taking. And getting the balance right is really the goal of regulation that has to accompany monetary policy at all times.
So in emerging markets, essentially, you have seen a very similar dynamics. You have seen a compression of spreads. The emerging market, generally speaking, benefited from the easing of financial conditions the same way advanced economies did. So you have seen a compression of spreads starting with higher rated sovereign, and then it trickled down to sub-investment grade. They accounted for a big share of issuance, for example, in the fall. We have seen pretty strong record issuance. At the sovereign level, it's about more than $200 billion for last year, about 270 for corporate, very strong last 3 months, and very strong January for sovereign. So clearly has benefited the broader asset class. We also seen portfolio flows returning, so that's a big rebound in portfolio flows. That's visible both for equities, but also for local currency flows. So clearly, the emerging markets also benefited. Now, there are some risk for emerging markets. A number of these countries run very large fiscal deficits, so there are fiscal needs and rollover needs going into 2021. Frontier markets also were shut off the markets for a while. We have seen market access, they're gaining market access again. There have been about 6 deals from frontier markets that have come to markets over the last 3 months, about $8 billion. It's almost $30 billion for the year. It's not a huge number, but if you consider the impact of the economic crisis, it's quite remarkable how they have been able to come back. Now, the risks they are facing are, one is slowdown in the global economic outlook, right? That would impact not just emerging markets, advanced economies. It's also, there is a concern about uneven distribution of vaccine. If that turns out to be some sort of asynchronous global recovery where advanced economies are one step ahead, they start normalizing monetary policy, that could have a bad implication for portfolio flows for emerging markets. In the end, emerging markets matter for advanced economies as well, right? So over the last 3 years, they accounted for about 60% of global growth. So if emerging markets slows, that would have implication for advanced economies. That's why we look at it from a global standpoint in terms of financial stability.
Good. In fact, you touched on an issue that a couple of reporters have asked about. The Press Trust of India asks the following question. How is the uneven availability and distribution of vaccine having an impact on financial stability of low-income countries, mostly in Africa and countries like Bangladesh and Afghanistan?
I think we can answer in general terms. Right? So uneven distribution of vaccine creates this risk of asynchronous recovery. So there's a health situation, first of all, that needs to be addressed as a health issue. There's also then an issue in terms of recovery. So if you get this asynchronous recovery, some of these countries lag behind, they could lose market access, financial condition may tighten, and then you would see really an increase in poverty, you could see an increase in inequality. So that's why it's important that we tackle this as a global issue at the global level, and there is an equitable, even distribution of vaccine across the globe. That's priority number one.
Okay, and a related question from Ahram online in Egypt. What are your views on capital flows to emerging markets as a result of loose monetary policy in advanced economies? And more important, what would happen if advanced economies began to tighten monetary policy? How would that affect some of these countries which have been such large beneficiaries of these inflows? A country like Egypt, for example.
Right, so I touched briefly before with your earlier question. So clearly the easing of financial conditions benefit emerging markets, right? So variables, what drives capital flows to emerging markets are the general global risk appetite. It's also in some sense what US rates do. So we have seen these large inflows coming back. Local currency flows lagged for a while. Now we start seeing significant inflows into local currency, and it's widespread. It's not just specific country. It's a pretty broad phenomenon. Now, if, again, we have this asynchronous recovery where the advanced economies go ahead first, and they start getting closer, commencing the normalization process, and rates are moving up, that could have adverse implication for emerging markets in terms of flows, as well as if you get a broad repricing of risk that Tobias was mentioning before.
Yeah, let me complement that thought. So, so the easy financing conditions are very valuable for emerging markets, and we have seen record issuance, not just of emerging markets, also many low-income countries have issued, frontier markets have issued, and we are hearing of some markets that are considering tapping markets. And so it is very important for countries to take into account that there could be volatility in capital flows at some point going forward. So use the good times to look forward to potentially turbulent times at some point. Having said that, the outlook is one, the baseline is certainly one where financial conditions remain accommodative for some time. So we do not believe that we are close anywhere to the point where policies should be tightened. Premature withdrawal of monetary or fiscal support is actually a big risk. So until we are out of this pandemic, until the medical issues have been solved, we certainly advise our membership to continue the substantial monetary and fiscal support. Greg, we can't hear you anymore.
Can you hear me now?
Yes, we can hear you now.
Okay,
yeah.
sorry. All right, sorry about that.
No problem.
You've talked about the risks of premature withdrawal of monetary support, but of course we know that one of the risks of this extraordinary monetary support is, well, for one thing, the benefits go disproportionately to people at the top end, the people who own most of the wealth. So it tends to aggravate some of the inequalities that we're very concerned about. Fabio, how do we reconcile those two things? What are the risks of pursuing a policy mix which tends to widen rather than narrow social and economic inequities?
Right. So the objective of policy here, as Tobias mentioned, has been to ease financial conditions so that the credit continue to flow to both firms and households. Right? So that we don't come to a complete halt the economy. That benefits everyone, benefits firms, benefits workers, benefits households. Now, we hit the zero lower bound, raised at zero, and central banks have resorted to unconventional policies, so asset purchases. Monetary policy always had distributional effect, right? When you bring rates down, it affects the distribution between consumption and savings. Now, asset purchases go, in some sense, one step further, because they tend to benefit with the easing of financial condition. Asset price goes up, and they tend to benefit financial asset owners, which is a much smaller share of the population. So clearly there are some concerns there. Now, the way to address this is not, in my view, to tighten monetary policy, but to use another tool that policymakers have, which is fiscal policy. Fiscal policy is the right tool to address distributional effect, and that's what we're seeing in a number of countries where fiscal policy is being used to provide lifelines, to take account of people that lose jobs, and provide income so that the economy can continue to go.
Let me just add to that, that of course there's the distributional issue within countries, but there are also distributional issues across countries, right? So what we're seeing and what we're forecasting, we did put out our World Economic Outlook forecasts yesterday, is that the recovery is on average quicker in advanced economies than in emerging markets or in low-income countries. So what we're seeing is basically more divergence across the income spectrum, and that will certainly be a policy challenge, not just within countries, but also across countries in coming years.
Okay. Tobias, you talked earlier about the fundamental stability of the banking system, but let's talk a little bit about what's going on in the non-bank financial system. And in particular, last March, at the outset of the pandemic, there was extraordinary instability and turmoil in credit markets, including in the U.S. Treasury market, one of the world's safest and most important markets. There were very large outflows from money market mutual funds. What sort of fragilities and weaknesses did this episode highlight, and what would your advice be to policymakers to do to make sure that this does not pose a threat to financial stability?
Yeah, that is a very important point. In March, we did indeed see fragility in many corners of the non-bank financial system. And we are working with the Financial Stability Board, that is the regulatory body that brings together all the market regulators and the central banks of the world. And we're working on a regulatory reform agenda for the non-bank financial intermediation sector. Let me highlight 4 priorities in that work. So the first one is one that you mentioned, which is the treasury market and other benchmark sovereign bond markets. Globally, it's not just the U.S. Treasury, but also the gilt market, the bond market, and the JGB market that are really at the foundation of global capital markets. And as you pointed out, there was severe illiquidity, in particular in the U.S. Treasury market. The trades were becoming very one-sided. The Federal Reserve stepped in first with repo operations and then with outright purchases in order to stabilize the market. And so there are a number of promising reform proposals that have been put forward for the market structure of the U.S. Treasury market. For example, our own FSUPs, these are the financial surveillance products for countries. For the US, in both 2015 and 2020, we put forward the idea of a standing facility for treasuries operated by the Federal Reserve, where market participants could repo securities, and that would certainly help. Many central banks around the world have such standing facilities, so that would be one important step. Secondly, there could be more centralized clearing in treasury markets. At the moment, you have quite a bit of fragmentation of clearing. So bringing more clearing to be central would be first order. And then finally, there are many issues around data disclosure. So that's the treasuries. Secondly, money markets dried up. And so the money market funds were an important element there. There were already money market funds reforms in 2015, but they didn't go far enough. And right now, regulators around the world are really unified in pushing the money market fund reforms further so that even in times of stress, money markets function well. I mean, that is absolutely first order. The third priority is on margin setting in CCPs. So futures and derivatives are cleared in central counterparties. That was one of the achievements of the Dodd-Frank Act and the post-crisis reforms. But we saw that margin setting in some of these CCPs, was somewhat unexpected. Margins shot up more than what market participants expected, and that fed into adverse margin spirals. So, looking at the margin setting in those central clearing counterparties is the third priority. And then finally, looking at the open-ended funds and the risk management in open-ended funds is a fourth priority. So those are the classic mutual funds, for example.
So a related question, as you know, a new administration has just taken office here in the United States, and they're appointing new officials in charge of a variety of our financial regulators, such as the Securities and Exchange Commission. American regulators come together in an organization called the Financial Stability Oversight Council to create a cross-disciplinary, cross-regulatory approach to financial stability risks. One of its responsibilities is to identify institutions that through their size and connectedness are systemically important and to designate them as such, systemically important financial institutions. But for a variety of reasons, this has not been done. In fact, I'm not sure that there are any right now.
No.
What would your advice be to the new incoming administration in terms of looking at the FSOC proposal, the SIFI designation proposal? Are there ways the IMF would suggest that this process can be improved, overhauled, what have you?
Yeah, absolutely. That's a very relevant and very important question. So, first of all, one important authority that FSOC has that has not been used to date is activities-based supervision and regulation. So. For the moment, so in the past, the focus was on designating individual financial institutions, and that had mixed success. So I think a more activities-based approach is really a promising way to go. And one of the hurdles there is that to date, many of the regulatory bodies don't have a systemic risk mandate. So to make FSOC really meaningful, I think it's crucially important to give each of the regulators a systemic risk mandate so that they don't only have a micro-prudential, but also this broader system-wide macro-prudential mandate. And at that point, you could really look at the financial system holistically, right? I mean, the problem by looking at institution by institution is that you're missing all the interconnections. And, the 2008 crisis really brought home the point that institution-based supervision has its limits. So the more activities-based supervision is very promising, but a lot has to be done to make that operational. So that's a high hurdle. I think there's momentum to do it, but it certainly needs a lot of collaboration across the agencies.
Okay, thank you. Fabio, I want to turn to you for a second and ask you about something that I think is getting increased attention among regulators of all types, and that's climate-related risk. What is the state of affairs right now with respect to how good banks and corporates are about disclosing climate-related risk, generally speaking? What's your advice on how that can be improved?
Yeah, so if you look at sustainable finance markets, last year was a really strong year. So issuance for the first 11 months of the 2020 was more than 650 billion. And a strong majority of that was green related, although social bonds also increased related to the pandemic. Now, we also see outstanding rising. It's more than 2 trillion outstanding of green bonds and loans. And that can be an important, the private sector, so sustainable finance market can be an important impetus in some sense to the recovery, right? If you're aiming for a green recovery, sustainable, inclusive recovery, green investment can be an important venue to do that, and sustainable finance market, so the private sector participation. Now, for investors to properly price climate risk, for regulator to assess financial related risk, you need data. You need data and you need disclosure. So in some sense, we need robust data, we need disclosure, we need a framework to think about this. In part, this has been done under the Financial Stability Board umbrella with the task force on climate-related financial disclosure. That's probably the most widely used framework in terms of disclosure. More work can be done there. I think the objective here is to avoid fragmentation, right? Avoid fragmentation brought from the regulatory landscape, as well as fragmentation in market. Those are global capital markets, sustainable finance, and so anything can keep the market global so that we use the same terminology, for example, in terms of taxonomies, the data are available. So the position that we have here at the fund, of course, would be great to have some sort of like minimally accepted global taxonomy. So we use the same terminology across the globe, and also some sort of like global minimum standard in terms of reporting and disclosure. Now, the fund, the IMF is doing work on perhaps both internally and externally along two venues. Internally, we're trying to bring climate-related issue into the annual country assessment and into the multilateral assessment and surveillance. So the financial stability, the global financial stability report that we have issued today, we have done work in past related to this, and including those into the EFSAP. We're also doing work internally to have a position in terms of disclosure. And then also the IMF is also involved externally, so international bodies. We are working with the Financial Stability Board on climate data and climate disclosure, with the Commission-led International Platform on Sustainable Finance, and also participating in the Central Bank, the Network for Greening the Financial System, the NGFS, where we are co-chairing a work stream called Bridging the Data Gap. The idea being that identify data needs, both from the perspective of investors as well as financial institutions and regulators, what is available, where the data gap are, and how to think about disclosure as a way to bridge this gap between what's available and what's needed.
Thanks. We're drawing to the end of our time, and I'd like to actually finish it with a question that links together a variety of these topics, is that part of what we've seen in financial markets, and at the beginning we started talking about the froth in equity markets, extreme valuations. A lot of the areas that have seen the most excitement are those specifically that appear to be leveraged to the green economy. And indeed, if we look at data on flows into so-called environmental, social, and governance funds, they're astronomical. They've grown significantly in the last year, coincident with two things, both the increased interest in ESG at a fiduciary level and this very low interest rate environment. And so my question is, are we at risk of taking something like positive and making it negative by creating essentially a very damaging degree of overvaluation in so-called green investments? And what, if anything, should we do about it?
So I think that, again, it goes back to the question you asked before, right? You need robust data and you need disclosure. We have done quite some work in the past Global Financial Stability Report, for example, looking at physical risk and trying to get a sense of whether equity markets were properly pricing physical risk. And the answer is that more needs to be done. That sometimes it's difficult to get a sense of what the overperformance or underperformance. You get different information from data provider and ratings provider. So I think one step to avoid what you just asked, Greg, is to actually have a solid, robust data and disclosure that allow climate investor, they are more bent toward ESG mandates, to actually do their homework, they'll do their credit work, and at the same time for the regulators, having data that allows them to do to assess what the risk in terms of climate are for financial institutions. So to me, it just goes back to the data and to the disclosure. That's a step number one.
Yeah. So let me add to that. Of course, we would expect that the relative pricing between green assets or ESG-friendly assets, so environmental, social, and governance-friendly assets, that should shift in the long run. That is an intended outcome of this capital market activity. We would like the cost of capital for ESG-friendly companies to be lower than the one that is potentially damaging the earth or is socially problematic. So in that sense, these shifts in pricing are exactly what we would like to see. But secondly, of course, there's also the cash flow component, which is that as we think into the far future, there will be stranded assets in the climate unfriendly sectors, and the yields to those that are investing into the future, into climate-friendly and socially responsible companies are expected to have higher profits. So it's both of these developments that are driving markets, and so it's both the risk return should be different. and the profitability outlook is different. And so I think part of what is happening is that investors are looking further into the future than they usually do, because of course these climate issues are fine to the future issues, and so the typical 2 or 3 year horizon is simply not enough. And so I think both of these are very good reasons to see large reallocations and to see large differential price movements. So I'm not convinced that it's necessarily unsustainable. I think it's rather a desired outcome.
Okay. Gentlemen, thanks. Fabio, Tobias, thank you very much for a very stimulating discussion, and thank you for the insights that you've brought to us with the update to the IMF's Global Financial Stability Report. And for everybody watching, thank you for listening in.
Thank you, Grep.
Thank you very much.
All right.
Bye-bye.
Bye.